Nike reports earnings this week, and October, often thought of as one of the more volatile months, is upon us. And we're going to talk about it today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. Nike and Lululemon are two of the most well-known athleisure stocks. Both meaningfully outperformed the S&P from the end of 2019 through that pandemic plunge and to the end of the year of 2021, and both have seen dismal performances since then. Nike, which will report earnings this week, is down almost 50% from its late 2021 all-time highs. Lululemon's all-time high occurred more recently on the last trading day of 2023. However, its performance from that peak to the present is essentially the same as Nike's. Lulu's down more than 45% year to date. The consensus is that Nike's fiscal first quarter sales will fall by about 10% year on year to about $11.65 billion. And expectations are that all regions are going to see declines anywhere from the mid-single to the low double digits amid weaker global macroeconomic spending. And the direct-to-consumer business is also expected to decline by mid-teens. The net income margin is expected to fall from 11.2% to 6.7%. And the only positive that the street anticipates, other than slightly lower materials costs, nylon, cotton, polyester prices are all down along with oil prices. So presumably Luon, that's the company's proprietary name for spandex in the case of Lululemon, is likely lower too. The appointment of longtime Nike employee Elliott Hill. Now, he retired from Nike back in 2020, and he did that after he was passed over to take the CEO slot. But he's now scheduled to actually become CEO on October 14th, replacing John Donohue. So Nike has recovered from stagnating sales in the past. For example, revenues and net income at Nike flatlined from late 1997 through 2003. And that's a period when Elliott Hill was at the company. He actually joined the company as an intern in 1988. And I have actually a long-term chart of revenues for Nike. I'm not sure if that's up on your screen right now. But you can see that basically their revenues were essentially flat from early 97 all the way through, we can see here, to about 2003. So we're looking at maybe a 6-year stretch where things were flat. And that was, as I've often said, if revenues are flat while the economy is growing, and certainly it did grow, although there was a recession in there, it did grow over that time frame, and then of course we had the tech wreck, then your business is actually shrinking in inflation-adjusted terms. Okay, so during that period, I mean, since 1988, Elliott Hill, he's the CEO-elect, again, he's going to be taking over in 2 weeks on the 14th. So he's occupied a number of roles. He was quite successful while he was there. And, you know, one of the things that I think is important here is that his approach, I think the presumption is that his approach to getting the company back on track is going to be product related. So John Donohue, as CEO, was focusing a lot on the how Nike was selling their products. So D2C, e-commerce, and digital. What we have seen from other companies recently, and I think Swiss athletic shoe company On Holding is probably the best example of this, is that if you have the product that people want, that's really what you want to focus on. And I think that's the presumption that many investors are making about how Elliott Hill is going to approach this, to focus more on product, maybe so more on what they sell, and maybe a little bit less on how they sell it. I don't know if that's really entirely fair. I mean, John Donohue, I think he's probably right that you want to build your e-commerce business, you want to build your DTC business, but you also have to create products that people want to buy through those channels. So since the announcement that Elliott Hill was going to be taking over, Nike's rallied about 10% on that news. And you know, as I indicate, you know, I'm pretty optimistic about what the company can do with him, or more optimistic, I should say, with him at the helm, simply because it is going to be more product focused. The issue I have, though, going into this earnings, and when I was looking at this over the weekend, and let's just take a quick peek and see where we are right now, it was implying a little over a 6% move on earnings. So the stock's trading 88.5, and the straddle is a little over $6. So it's a little bit higher than that by week's end. We'll call it somewhere 6.5 to 7% implied move. The thing about it is that nothing that comes out in this earnings is going to be reflective of essentially their shift in strategy once Elliott's back in the saddle at the company. So my thinking, therefore, was that one should, if you are inclined to take a bullish bet, probably use calendars, call diagonals most likely. Now, I want to make one other quick point before we pull up the actual options trade, and that is that if we measure pessimism in part by the multiple that the company is trading relative to its own history. So if the company has typically traded at a market multiple, so we'll say that the S&P is trading, call it 24 times earnings, and now it's trading at a significant discount to that, then we would say that that suggests investors are more pessimistic than they have historically been. And I'm just going to get rid of the forward earnings because it's kind of hard to say how that's going to play out. But this is, we're looking now at a 30-plus year time series of Nike's multiple to trailing earnings. And I'll draw a line here so we can just sort of see what we're looking at here. So it's 22 times. So this is pretty much right. I don't know if it's in the middle. Let's see what the mean is. We probably have that down here. The average is 23.4. So it's below average, but remember that that average is getting thrown a little bit by these really high points. And those high points, of course, exist because those were extraordinary periods. The pandemic plunge, earnings plummeted, makes sense. We had that sort of recessionary period back in the late 90s. I alluded to that earlier. Earnings plummeted, valuation didn't fall quite as far, so the multiple rose. And so if you throw that data out, then it's probably trading on or about a mean market multiple. However, we could, of course, throw the S&P in here and compare that multiple. And, what we're going to see, putting the S&P's market multiple in here, is that the S&P is, of course, trading at a much higher turn to its trailing earnings than it has historically. So on a relative basis, Nike is trading quite cheap. And I always like to think of those, as a relative thing. We want to know how expensive a company is relative to its own history. We want to know how expensive a company is relative to the market, relative to our expectations, and so on. So it's trading at about a mean multiple for 30 years to itself, but it is trading at a meaningful discount to the S&P. So what I'm saying is that if you believe that the company can at least get back to GDP-like growth and maybe even back to S&P-like growth, then you would expect to see some convergence in these. That would be 4 turns, approximately, of earnings. And also we would, expect to see some improving earnings because bear in mind that margins have been falling. Peak margins were probably 15%. Expectations for next year are less than 7%. So this isn't going to be a really fast turnaround, but I think there is potential here. So that's the fundamental backdrop. Obviously, as I pointed out, the stock has had a bit of a pop off of this news. I think it gave a little bit of it back today, and yeah, so the last couple of days we can see that. But it was right back here. It was right in, I think it was the 19th that they made this announcement. So the stock was trading about 80, jumped to 90, so more than a 10% pop on that news. But again, none of what Elliott Hill is going to do for the company, and he's a he's a lifer at Nike until he left in 2020. None of that's going to actually, really flow through to the bottom line straight away. So just important caveat there. So where that leaves us, if we're looking at a trade, and I don't know, here's one other thing I want to show you really quickly too, and that is that this implied move of, Bloomberg's got it at 6%, slightly larger than that, I think, right now. But one of the things you're going to observe is that actually over the last 8 reported quarters, this thing has really whipped around. Fell 20% on the last earnings, down 7% the one prior, down almost 12% the one prior to that, up almost 7%, had 2 sort of lackluster quarters where it didn't move that much, and the prior 2 quarters were moves of 12% plus, one up, one down. The point I'm making is that options prices, and we're going to be looking to sell October options, while they are elevated somewhat for this event, are, if anything, very reasonably priced. However, since we're going to be buying longer dated options, that doesn't matter a whole heck of a lot. Obviously we're going to be capturing the election and the longer dated options no matter what. They're going to be reporting in the 3rd week of December. I was actually thinking go out to January or March though, because this is going to take some time to play out. You're not going to get anything about it on this earnings call, and you're going to get precious little about it on the next one, because Hill takes over on the 14th, and the quarter that they're going to be reporting in December is going to be ending November 30th. So that's going to have given him about 6.5 weeks, 7 weeks as CEO to do anything. And of course, you're not going to know what the Christmas season is all about at that point either, since they're going to be reporting just prior to that, or at least that's the current estimate. Okay, so just taking a look at what trades we would potentially be considering then. Buying an at or a slightly out of the money, longer dated call, selling something a little bit nearer dated that will see some of the vol crush that takes place as a function of the upcoming earnings. Oh, it's actually auto-populating Lulu because I was probably looking at that earlier. So going out then to either January or March, fine. Selling the October regs in this case, that's also fine. And let's see, that should be a call. So something along these lines here. October, Jan 90, 95 call diagonal. It's about 470. Get a little bit of vol crush. You could probably even think about it if you were willing to take the risk. Now, I'm going to get to this. As I alluded in the open, I said, there's a perception that October is a more volatile month than average. That is somewhat true. I'm going to explain what I mean by somewhat true. If you take a look at 95 years worth of data, is it true that October is a more volatile month than average for the S&P? Absolutely. But we're going to take a look at that data a little bit more closely to understand whether or not that's really, really meaningful. Okay, so that's a trade there. Now, the next thing I want to point out, though, and the reason I was bringing up Lulu is not reporting earnings. But I brought it up because the conversation about Nike started on Fast Money last Friday. I was doing the full hour, and as I thought about it, I thought, it's interesting. Nike's revenues are declining. Their margins are declining. They're swapping out their CEO, and still they're trading 22 times trailing, 26 times forward. Lulu is trading significantly cheaper than that, and they're not shrinking. They're growing less quickly. But at least so far, we have not seen negative growth out of the company. I think I have a chart here. So this is a 5-year chart right now. This is just the earnings chart. Now, bear in mind, Lulu's earnings are really quite choppy. So they, have sort of a seasonal effect. And actually, you also see that on their revenues, which I'll throw in here. But as you can see, in general, going over the last 5 years, the growth trajectory for Lulu is meaningfully steeper than that for Nike, which is actually has topped out and is rolling over. Now, we can actually also maybe very slightly observe a trend that their growth is similarly slowing. But they're trading at a big discount at the moment to Nike. What do I mean by that? So specifically what I'm referring to here is, again, I mean, it doesn't really matter which multiple we want to look at, but why don't we just take a look at price to earnings? And I'm actually going to put Nike in here so we can see this a little bit more closely. And I'm just going to get rid of these prices, so we're not going to look at that. All right, so these are the multiples. Let's just go back 10 years. And, here you've got Lulu. Okay, so Lulu is trading 19. I mean, this is pretty much the cheapest you could get Lulu in a decade. And it's trading less than 20 times earnings, with the S&P trading, mid-20s. Contrast that here. We can see, obviously, Nike is lower than it has been, but it's a higher turn. So if what I was saying was true for Nike relative to the S&P, then I would suggest that it is as true or truer for Lulu relative to Nike. Bearing in mind all of the things that we would otherwise acknowledge, which is consumers are in a tough spot, declining savings, increasing debt, higher delinquencies, all the rest of it. Now we're getting a little bit of stimulus. Now Lulu, again, not reporting earnings, but there is a bit of a bump as a result of the election volatility, which I alluded to last week in other live streams. So here too, you could affect a very similar strategy. And one other quick point I would make is that, Lulu feels like it's kind of bottomed out here. Let me see if I can pull up a longer term chart. This one doesn't really, and this is maybe a more, just as important an issue as anything else, which is that it's fine that the valuations look reasonable, but valuations are by themselves not going to indicate entry or exit points into stocks. They're simply not that effective as a trading timing tool. But they are important for us to pay attention to, because these are the things that give us conviction about, those things that we're willing to hold for an extended period. And, Lulu was for a long time a constituent of what I like to call the Holly Index. More recently, as I've also alluded to on prior live streams, Vuori appears to be higher on Holly's list. But as we take a look here, I just want you to observe this for just a moment. Okay, so in terms of technical indicators, all but 6. So 22 technical indicators, ignore buy and hold. All but 6 of these sort of primary 22 technical indicators are positive on the stock here. We can take a look. We can see that it appears to be sort of turning the corner, possibly a bearish to bullish reversal. I think we would get more confirmation of that if we got through. I have a tendency, just because I learned that from my good friend and colleague Carter Worth, who is a technical analyst. I am not. My habit is now to look at the 150, and so I'm really looking for something like that, or that, or that, and we haven't quite gotten it yet, right? So we're right about at the 100, but this is a potential turning point. Valuation seems reasonable. We're coming into a strong season in terms of sales and revenues, so I think those are all positives. And it's also interesting. I mean, we are seeing some broadening to the rally a little bit. It's not just Mag 7 stock. So here too, again, if you were looking to dip your toe, you could do a similar strategy, bearing in mind that the front month that you're going to be selling is not, that's not going to capture an event like earnings. But that's really not, it's really not a problem. Maybe pick out the 280s and go out to, you could even go as far as March if you chose, and then sell NOV, sell Ds. You can sell into the next earnings. I think that'll actually capture a couple, right? Plus the election. That's going to look a little something like this. And you can tell that the term structure is flat enough when you're able to put these diagonals on such that you get a standstill return that's not, you don't have a negative standstill return. It's probably going to be slightly positive, and you have no point of loss no matter how high the stock goes. So you're going to be spending less than the distance between the strikes. But that's another trade that I think you might want to think about. Just came to me as I was thinking about the situation with Nike. Okay, so this brings me now to, before I go to some more questions, I just want to address this thing which keeps coming up about October volatility. So first things first, is October a more volatile month? Okay, so what we're doing here, so this spreadsheet that I've constructed here calculates the daily sigma, the daily standard deviation, and then annualizes it as well, going back almost a century. So this is all trading days going back to 1927. It's not quite a century, but pretty close. And so what we can see is that the average annualized standard deviation is about 18.7%. Now, as a reminder, because this will help you conceptualize this, like, is that a big number? Is it a small number? How do we think about that? As a reminder, you can calculate the standard deviation for different periods of time by multiplying by or dividing by this square root of time. So, for example, if you're dealing with 256 trading days, the square root of that is 16. So I can convert from 1 day to 1 year using a multiplier or a divisor of 16. And that's what we're doing here. The reason I'm doing this is simply because options traders usually speak of annualized vol. Oh, I paid 30 vol, or I sold 40 vol. When they say that, they're always speaking in annualized term, regardless of the tenor of the option. So just bear that in mind. And you can then do whatever requisite calculation is needed to do that math. If there's 49 days until expiration, you can calculate what that works out to in terms of an annualized number by taking 365 divided by 49, and then you take the square root of that and you multiply, divide, and so on. Okay. But when it comes to conceptualizing whether that seems like a big number or feels like a small one, usually thinking about it in daily terms is helpful because we get a sense of how the market behaves from one day to the next. If the market moves 30 basis points or 40 basis points, that doesn't seem very surprising. If it moves 1%, that's a pretty big move. And the average move, from a statistical point of view, the way you can convert standard deviation to the average move using a statistical term is something called the mean absolute deviation. And what you do is you take the standard deviation and you multiply that by 0.8. That gets you approximately to the mean absolute deviation. So in this case, an annualized standard deviation of 18.7, if volatility was constant, and it always did that, you would be expecting to see daily moves of about 93 basis points. And I'm guessing that when you hear that, you say, well, the market doesn't usually move 93 basis points. And you might also say, well, there are going to be days when it moves a lot, and they're going to throw that number a little bit relative to the days when it doesn't move so much. That's all true. But that still feels like a pretty big number. And it is. And part of the reason that it is because some exceptionally volatile periods creep into the data and they start throwing things off. So, for example, we're looking at these numbers and we say, well, that captures the Depression. What if I said I want to look only at dates that took place after World War II? Why don't we just start, for the sake of argument, we'll start at January 1st of 1946. We'll take a look at what happened to those numbers. They changed a lot. The annualized standard deviation fell to 15.5. The daily standard deviation fell to 0.97. And actually, the exact number is 0.79 to calculate the mean deviation. And what that gets us to, because it's the square root of 2 over pi, is an average move of about 76 basis points. Okay, so that probably feels a little bit more like the kinds of things that you normally experience. Well, let's imagine further that we exclude from that data a handful of incidents that were really out of the ordinary. The crash in 1987, for example, the October, crash. Let's see if I can, not all the items are showing. Okay, so we'll go in here. So let's just say I'm going to pull out, I want to pull out just a handful of years in here. I want to pull out 2020, the pandemic plunge. I don't like that. I'm going to pull out the great financial crisis, and I'm going to pull out the crash in 87. And you can see what happens here. A handful of events can throw this data fairly meaningfully. All right, so I'm going to leave the filter on where we're only looking at the markets in the post-war period. Or actually, maybe it doesn't matter. I'll select them all, just for the sake of argument. So we're going to go back and we're going to take a look at all events. And then we're going to take a look at October volatility. Now, you get into a situation here when you're doing data analysis that when you start filtering down on things very meaningfully, your sample size starts coming in to a point where it means the data may not be quite as meaningful. And to think about that, you can imagine that in every, we're looking at almost 100 years worth of data, but if we start looking at individual months, how many of those months took place, during that time frame? Well, each month occurred only once per year. So if it's 95, 96, 97 years that we're looking at, we went from looking at 1,000 months, if you will, down to less than 100. And if we start filtering things out for various reasons, suddenly we're not working with a very big sample size. So that's just something to think about. By the way, one of the things that I also thought was kind of interesting, and you might find this interesting too, is I'll ask this question before I show you the answer and say, what day do you think on average is more volatile? Mondays or Fridays? So I'll let you think about that for 1 second. Mondays or Fridays? If you went back for 100 years of data, and every year there's 50 Mondays and 50 Fridays, and I give or take, because we always have Good Friday off, so that's definitely not 52, so that's one that's going to be off. And then there's probably another holiday or two that throw out. So Mondays. Anil says Mondays. Says Mondays. Anybody else got any thoughts on this? I'll wait. Steven says Friday. Okay. So, well, Black Monday occurred on a Monday. So we know there's at least one data point in there that's going to be shaky things pretty badly. In Excel, the way they number the days, Monday is represented by 2, Friday by 6. So we got Monday from Alex V. Here we go. So we're going to go for our answer. This goes back to late 27, really to the beginning of 1928. Mondays. Daily sigma 1.38%, annualized 22.1, which is above average. And Fridays, 17.3. So the answer is that Fridays are below average, Mondays are above average. But the next question we have to ask ourselves is, well, is this really meaningful? And this is what I was alluding to before. When you start picking things out like that, we know that there's a handful of data points that really throw it. So going back to the monthly business, so now we're going to look at months. Is October more volatile than other months? That's what everybody believes, right? So that is the consensus view. And of course, the huge volatility we saw in 2008, Lehman, all of that, October was horrific. 1987, that crash was in October. Crash in 29, I believe, also in October. And so if we only look at Octobers, sure enough, we get a much higher volatility. So that would at first seem to confirm things. So everybody's saying, well, gosh, okay, so October begins tomorrow. October is typically much higher volatility. And 25.8, by the way, is a lot higher than 18.7. It's a lot higher than Fridays across all periods, which was 17.7. And what's interesting is if you took Fridays and you threw October out, you know, who knows what you'd get. But you see what's going on here is that there's a whole lot of data mining that's sort of going on. And as we start drilling into this data, it's not quite as clear cut. So first of all, maybe we can agree that the Depression, because we're not in a Depression at the moment, and World War II might not necessarily be the best representative. So I take that out, and 25.78, whatever, suddenly we're down to 21.7. Okay. And then maybe I say 1987, which was the result of portfolio hedging activity, was not really representative. Lehman Brothers is arguably not that representative either. So we're going to take those 2 years out. And what do we get? Well, now we're down to 16. Yeah, and Anil makes a point. So this is really, and Anil's point here goes right to what I'm talking about. I'm going to throw this up on the chat. So also add it to presidential election years. So can we do that? Can we go to just election years? How meaningful will that be? I mean, were the elections during the FDR years really elections at all? Kind of a foregone conclusion, right? So we can kind of rule that whole 16-year stretch out. Elections only happen once every 4 years. So if we're only going to look post-World War II at October, and we're only going to look at election years, and we're also going to filter out some of this other stuff, you start narrowing the number of Octobers that you're looking at pretty significantly. And, you know, it becomes a lot less clear-cut. So there was a professor at Baruch College in New York who taught business there. His name was Aaron Levinstein. And he had a quote that I've always liked, and I've actually misquoted this before, so I am going to just quickly get it. But he was comparing statistics to bikinis. And let me see if I can find this one really quickly. So the quote was, let's see if we can find it. Hopefully I can find it here. I thought I put it in here somewhere. Where did I put that? Let's see. So Professor Levenstein said, statistics are like bikinis. What they reveal is suggestive, but what they conceal is vital. What they reveal is suggestive, but what they conceal is vital. And I feel that when we kind of offer data like October is more volatile than other months on average, this is exactly what we're talking about. That is true. Unless you get rid of 2008 and October of 87. Right? I don't think I even pulled the pandemic year out of this. And of course, the worst of the pandemic plunge took place in March. So I didn't even scroll up that far. So is it true that some of the most volatile periods we've ever seen took place in September and October? It is true. Does it mean, though, that we may infer from that Octobers are more volatile in general? That is much less clear. So whenever you hear that, and I think I myself have probably said it. I mean, it came up last week on CNBC, and I did go along with the fact that it's a higher volatility on average. But I wanted to, in this format, we can take a little bit more time to talk about it, and you can at least contemplate why that is. It's true, but the reason it's true is because of a relative handful of Octobers over the last century. 3 of them, basically. And if you yank those out, then it does change it somewhat. Okay. All right. So I did think it was interesting, though, that Mondays are more volatile. And there's a couple things about that also, which I just add one other thing. There is a functional reason why that would be true, and that is that there is an accumulation of data that can occur to which securities prices cannot respond until Monday. So news comes out on Saturday, the markets are closed, comes out on Sunday, market is closed, comes out in the pre-market. Asia and Europe open up before we do on Mondays. So Monday morning on the open in particular, you will, now with futures trading and trading, you can see that a little bit better, of course. On Sundays there is a mechanism for it, but that's all going to get baked into the price for equities when they open on Monday morning. Anyway, but my point is that if we can imagine that stock prices are these balls, moving around the billiard table, and all of the things that drive those prices are all the other balls that are flying around the table. Well, there's a lot of movement going on during the weekend to which live prices can't respond meaningfully until the market opens. And so that would be one of the reasons that you might expect to see that. It's one of probably more than one, but just something to think about. Okay, so with that, let me go and take on some questions here. So Ranjana Gupta asks, please explain the put-call ratio and its interpretation. It can be calculated using volume or open interest. Which should be used, or do both have their place? Also, do you use this ratio yourself? Do I use the ratio? Not really. Do I observe the volume and open interest of puts relative to calls by security or by underlying over the course of time? Yeah, I do. So a little bit of history here. The put-call ratio was, in its earliest days, used as a contrary indicator. So as the put-call ratio, so the number of puts, significantly began to outpace the number of calls, or at least that relationship changed meaningfully in the favor of puts, the logic was that reflected a lot of bearish sentiment. And whenever any side of a trade gets very crowded, then there may be some benefit to being contrarian. If, for the very reason that if it reverses, that reversal could be extremely sharp. Bear market rallies tend to be very sharp. Short squeezes in stocks that are otherwise declining can be exceptionally sharp. We saw that in AMC. We saw it in GameStop. We've seen it in many instances. So that is the origins of it. And it should be noted that when the put-call ratio, and let's just take a look we'll look at it in Lulu. It doesn't really matter what we look at it. So we can look at it in terms of, here we're going to do this. So first things first, this is on a volume basis. If you can see this chart. And I'll shorten this up. I'll just go year to date maybe, or even just the last 6 months. Okay. So this is the volume. We can see the call volume in blue. We can see the put volume in green. All right. And we can see that in general, the volume of both of these have gone up in conjunction with each other. There are exceptions. Here is one right here. Massive amount of put volume in April that was not matched by the call side. And actually, one of the things we can see is that on the most meaningful spikes, excluding this one, usually when volume spiked, it was the put side that spiked far more. It did here. And this is just a 6-month chart, right? So, if we went back further in time, this is probably true. Here, so back April 10th-ish. Here, so on the 17th. Here, we're looking at the 22nd. Here, back on June 13th. Here, this is a little bit less meaningful, but on the 20th. Here, on the 25th of July. And here, on August 30th. In all of these instances, we saw a spike in volumes, and put volume spiked more than the call volume did. So that is on the volume side. Now, we'll just take a look at the open interest. So here's now the open interest. And open interest is you're going to notice a pattern here, or maybe you'll notice it. I don't know. We'll see. So open interest charts can be a little tricky sometimes because you need to account for all of the expiration dates. So open interest will build until expiration and then fall. Build until an expiration, fall. And so if you look and you see a lot of these big falls in expiration, you'll notice that they don't correspond necessarily to closing volumes. It's just that a lot of that happened to roll off. So I will tend to look at this after I've looked at other things. And the other things I will look at first are typically implied volatility, skew, which is the relationship between the volatility of the out-of-the-money puts and the out-of-the-money calls, and the price chart of the stock. So why is that? Why would I look at implied volatility first, and why did the people who came up with put-call ratios not do that themselves? A couple of reasons. First of all, the implied volatility of puts relative to calls in some ways is a better indicator of the sentiment. And the reason is because there can be a lot of volume, but what if all of that put volume was put selling? Well, if it was put selling, we should expect that the sales, that is the initiating customer side with selling puts to the market makers, what do market makers do? They buy, lower the price, lower the price until the market turns buyer, and then they raise their price, sell some, raise it, sell some more, and so on. So what happens is that the implied volatility surface is shifting in real time as a function of demand. So if the open interest is building, but the implied volatility is declining, then the initiating customer side is likely selling. And so that tilt becomes maybe as good an indicator of sentiment as the volume does or the open interest. So what tilt am I referring to? Well, let's take a look at this. Okay, we're going to figure out where the open interest is. We'll pick an expiration. All right, so we're looking at October here. You can see the bulk of the open interest is in looks like the 230 puts. And this is October regular. So why don't we just take a look then at skew, which is the shape of the smile for that expiration. Now, I recognize that maybe it's not that easy for everybody to pull this kind of stuff up all the time, This is where we are today in white. This is where we were 1 week ago. And I could pick this for any time. This is based on moneyness. Now, I want to make a point that you can't really, it's not that easy to adjust. You shouldn't look at it by moneyness or by strike as you're comparing one expiration at very different periods of time. And the reason for this is that the statistical likelihood of a stock declining 10% changes meaningfully when you think about the time horizon you are providing for that movement to occur. So a 10% move for Lulu over the course of 1 year isn't a huge move at all. Over the course of 1 month, it is a pretty big move, but it's happened. Over 1 day, it's kind of almost an unheard of thing that happens only on events, catalysts, such as earnings. So we need to kind of adjust how we think of what's out of the money on the call side and the put side. And we can do that a couple of ways. We can do it in terms of standard deviations. So we can look at calls that are 1 standard deviation out of the money, 1 sigma, puts that are 1 sigma out of the money. Or we can do it by delta, which, delta, as I've previously described on live streams, is the probability that the stock is going to be, well, it's the hedge ratio. It's the immediate change in price of the options value for a change in the underlying asset, but it's also the probability that that option is in the money. So if you have a 30 delta option that expires in 1 month, and maybe you can compare that to a 30 delta option that expires in 3 weeks. So if I'm looking at that 1 month from now and I want to see how it changed from 1 month to the next, if I think about it in sigma terms, and fortunately for me, Bloomberg allows me to do this pretty, oops, I put strike, which is not what I wanted. But if I put delta in, I can do that. And you can see that the shape of this is going to be relatively consistent. And then I can just do this now for various periods of time and see how those options have changed relative to one another over the course of time, and see whether that's telling me that the market's becoming, arguably more bearish or whatever. And if I do this, so I'm just looking at that same expiration going back in time. So on the 6th, that was in blue. We can see that implied volatility fell, but remained approximately the same shape. The next week, we can see that it was higher, but a little bit more of a bid to the calls thereafter, and we can see it's much higher now. And that's actually not surprising. We saw some relatively big moves recently. So put call ratios, just to sort of button that question up a little bit. Do I look at it? I do, but if and as and only after I've looked at all of these other things. And oftentimes I will look for changes in open interest and volumes just so I can then try to pinpoint what the trade was. So I'll say, oh, there's a big spike in open interest. When was the volume spike? It was probably right around that time. There it was, the day prior generally, right? That would be when it would have to be. Settlements T+1. Identify the big volume. Go see what traded, if I can. And figure out whether the customer side was buying or selling. Was it retail flow? Was it institutional? That kind of thing. Was there an identifiable catalyst that they might have been targeting? Because that's another important point. Oops, not event. That's not what I meant to do. Was there something that they were targeting, very likely, that I shouldn't necessarily be thinking of as all that important now, even if that open interest still exists? So, for example, if I was looking at earnings, here's a chart. Here are the big events that took place in here. You can see that there were some big price moves, but that was some big trade reversal, but this was probably an earnings. No, oh, that was S&P inclusion. They reported some things here. Let me see. What are we doing on the key events? What key events are actually getting selected here? Oops. I don't want that style. I want to edit what's in there. Well, I'm going to get back to that, but I think what's going on, I'm going to put events back in. I probably had a setting here just to look for, it's probably just screening for the biggest news on the day on these big moves. But I can go back and select when earnings were and things like that. And if I see a big bunch of volume that took place right before one of the catalysts that would have been identifiable. This one, for example, intraday reversals. Well, someone didn't buy options 3 or 4 days prior to that anticipating a big reversal. Well, maybe they did, but that's not something that you would see on the calendar. So if I've identified a meaningful catalyst that would have been known contemporaneously along with the volume and to which I could attribute that volume, I'm less likely to think about that open interest now. The other thing is that open interest, it matters where it is. We were just looking at that, the 230 puts. Well, the 230 puts are not that close to the money right now with the stock trading 270. So some people will look at things like the gamma exposure. So that's what this chart is. If you can see this on your screen right now, you can. So this is just, it's an basically they aggregate all of the open interest and see where most of it is. And then you can assume that if market makers are long or short strikes, they have to gamma hedge accordingly. So if you are long gamma, that means you buy the stock as it declines. And if you are short gamma, that means you sell it as it declines. And the opposite's also true. Long gamma, you're selling it as it rises. Short gamma, you're buying it as it rises. Big market maker short gamma positions can aggravate volatility, and big long open interest, long gamma exposure by market making community can compress it for those reasons. It's one of the reasons why stocks spin. So you'll sometimes see that stocks feel like they're gravitating towards a strike with a lot of open interest on expiration. And it doesn't just feel that way. They actually are gravitating towards it. If market makers are long a lot of that strike and sort of in that prisoner's dilemma, ideally what they would do is they would all sit it out and do nothing and hope that the stock makes a break for it. But because they've got this prisoner's dilemma and they're trying to milk the most that they can out of those positions, they are sort of falling all over each other to buy as it declines and sell as it rises. And that compresses the stock price towards the strike, where all the open interest is. And because gamma increases as expiration approaches, the amount of that activity is similarly increasing. So it's kind of as if the stock is beginning to approach a black hole. If the expiration is far off in time, there's not a lot of gamma. The gravitational pull is not that great. But as expiration approaches, that gravitational pull starts going up exponentially. And so it basically is just sucking everything around it towards the strike if they're along the strike. So that was a very long conversation on put calls, but I do look at it, but it is not something that it's always going to be the third, fourth, fifth thing that I look at. I'm looking at a lot of other things first. Bill Baruch on September 26, PC writes, Bill Baruch on September 26, noontime CNBC on the halftime report, closed his Micron Technology DEIS 110.25 vertical spread that he bought for $275, sold it for $612 in the first 15 minutes that day. He said he was close to the maximum $7.50 for the $15 wide spread. What could be the rationale? Long-term spreads have significant time value and data of spread was accounted for. Well, let's take a look at Micron and where it was on the 26th. So this is much too much data. So let's just do this. We'll look at a candle chart for the month. So the stock rallied 110.25 vertical. Stock was trading 112.60. So, or thereabouts. Actually, did he specify exactly what time? He didn't say exactly what time, but I guess it doesn't really matter. We could We could take a look at the exact if we wanted to. Just take a look at the intraday. What the hell? So this was on the 26th. All right, so here's the intraday. He did it on the open. It was we'll call it 112 bucks. It was $2 in the money. That call spread, and he sold it for 612. And what could be the rationale? Well, first of all, if you're long that vertical, which is $2 in the money, and it's 7.5 bid, and it's $15 wide, time is not on your side. There is considerable time value. How much time value is in that spread? Well, it's the difference between the premium that he collected for selling it right then and there and its intrinsic value of $2, which was $5.5. So those $5.5 of time value, $5.5 or about 5% of the stock price is how much that call spread stood to lose if he held it all the way until expiration. And that, if he thought it was, the bid was overdone, that the pop was more than was deserved, what I usually would be inclined to do is roll, unless I really fundamentally think that it's made all of the move that I expected. He was long the 110.25. Stock only got to 112. It's hard to imagine that you would buy the 110.25 call spread if 112 was your target. So I guess he probably just felt that the stock had made all of the move that it was going to, and he didn't want to pay the decay. I'm assuming that's the rationale. Okay, Bunny 23. Carter suggests to sell strangles at times. Quite frequently, I would say he does. He likes to look for stocks that have made their move and then find boundaries which he thinks it's unlikely the stock will violate to the upside and the downside. I have actually evaluated the performance of his short strangles year to date. They're about 72 or 3%. The last I looked at them were profitable. Actually, I think 72 or 3% of them expired worthless, meaning that he was 100% correct. And I think something like 80% were profitable. So that including the 72% that went out worthless, there was another 8% that actually violated the short call or short put strike. And more often when it did violate, it was the call strike. Again, at his request, I've actually looked at the performance of some of his trades. So more often when he sold a strangle, it violated it on the call side than the put side. And the performance on a risk-adjusted basis of those short strangles has been actually very good. Better than the risk-adjusted performance for the S&P. What do I mean by risk-adjusted? If you sell a call or if you sell a put, you are taking an equity-like risk that you could either short the stock or you could get long the stock. Long the stock at the short put or short it at the short call. So I think about the risk that you're taking as either long or short risk, equity risk, one up, unlevered. And the rates of return that I saw for his short strangles was in the very high 20s with a very high probability of profit. So yeah, he does do that. And his results are looking pretty good, I have to say. My retirement account, so the follow-up part of this, my retirement account would not let me sell the calls for a credit. What is the alternative to sell a call for a credit? Is selling a call spread. So the reason you cannot in a retirement account sell an uncovered call is because the risk is theoretically unlimited. And in retirement accounts, even if you are still contributing to them, you're not free to contribute any amount at any time. Because there are restrictions, it can't be based on your credit, your financial wherewithal to cover the trade. It actually has to be covered by the account's wherewithal, and that's why they don't do that. So as far as I know, no retirement accounts allow naked call selling. Some allow credit call spread sales. Almost all will allow covered call sales, own stock, sell upside call, and almost all will permit cash covered put sales. So if you sold, for example, a 100 strike put, 100 strike put, then, and you had 10,000 bucks in the account, so 100 times 100 is 10,000, so you're buying 100, and that would be actually more than would be required because presumably you're receiving some credit to do that. So let's say you sold that put for $3, you only need 9,700 to cover the trade. And most retirement accounts will permit you to do that. So you can find out whether your broker, your clearing firm, will permit you to sell call credit spreads to do that. The alternative is, of course, that you could just sell the put side. It's less attractive. Here's one of the things about selling strangles. Now, this is not for the faint-hearted because you could either take delivery of the stock or you could be short the stock. If it goes up a lot, you're short. If it goes down a lot, you're long. So understand that risk. That's the first thing. And not everybody is cut out for taking those types of risks. I wonder, they probably don't let you do calendars. A calendar would be a way to do it, I suppose. Things like strangle swaps would offer performance that was related in some cases, depending on implied volatility. So that would be another way to do it. But I don't know whether they'll consider that covered. I would check. I'll ask Interactive Brokers. I could always ask them because they tend to be pretty flexible, but and they might be representative for those types of accounts. Things you could do to look to sell call credit spreads on the upside if your account permits it, and then just sell the cash covered puts to do it, or just sell calls against the stocks that you own and maybe sell downside cash covered puts at levels where you'd add to those positions incrementally, right? That would probably wouldn't get you exactly the same characteristics, but some of them. Okay, so hi Mike, thinking about being long PayPal through the earnings on October 30th, buying an 80.85 November call spread for $1.75. What do you think interest rate and election impact on PayPal could be? So, all else equal, well, first of all, you're doing a call spread, buying one, selling the other. And the carry cost of a strike goes up as interest rates rise, and it declines as they fall, right? So carry cost, at least as far as interest rates are concerned, rise with rates and fall with rates. And that should make some sense. One way to think about it is that if you had to borrow the cash to purchase the stock, how much are you paying? Or in the case that you have cash on hand that is being paid interest, overnight interest, how much are you foregoing by using that cash to purchase a security? The higher short-term rates are, the greater that cost is. Makes sense. So therefore, as rates rise, all else equal, and that's important, all else equal. So as rates rise, the value of a call goes up. As they fall, the value of a call goes down. All else equal. So same stock price, same dividends, everything else. However, if you're doing a call spread, that's going to have an impact on both the long and the short side. So you're mitigating that. The sensitivity that we're talking about, the carry cost sensitivity, which is a function of both interest rates and dividends, is rho, right? So that's one of the primary Greeks. So delta, gamma. Delta is how much an option changes as the price of the underlying changes. Gamma is how much delta changes as the price of the underlying changes. Theta is the decay of an option for each day. Vega is how much it changes as implied volatility changes. And rho is your sensitivity to carry cost. And rho is impacted by two things primarily, and those two things are interest rates time, of course, but interest rates and dividends, right? So increases in dividends reduce the carry cost, and interest rates increase it. So if you're doing a call spread, the row impact of the, you know what, why am I have such a bad habit of doing this. I don't need to just explain it. So I'm assuming you're talking about interest rates, just in general rate policy, FOMC stuff. But let's actually take a look very specifically at the rate impact of the trade you have in mind, which was the October 30th. So let's do that. 10:30. Oops, sorry. 10:30, and you were looking at the 80.85. So we'll get long the 80. Okay. All right. I'm being told that I've dragged this out, so I'm going to try to really get a little bit quicker here. There's your, well, actually, there's basically no row in these things, but yeah, the point is that the row of the long option offsets the short one, so the rates aren't going to play that much into it, although lowering rates, seems like everything's a reason to buy stocks here, but lowering rates would certainly be one of them. Don't fight the Fed and all that. Election volatility is also, because you're long one option, short the other, going to impact both. So that is also something else that I don't think you need to worry too much about. And just in terms of implied moves, so the average move is 6 1/4. The implied move is 8.3 according to this. And that is also not that unreasonable. 2 points in terms of all. If you wanted to have a little less, I mean, October 30th expiration is a very precise, targeted trade, looking straight to earnings. It's win or lose. It's binary. If you chose November regular expiration, you still get to capture a little bit of that election, right? Okay. So hopefully that will be something for you to think about. When will it be time to buy Warner? Oh, God. Walgreens boots. So bad it's good. These things, I mean, these things are just, they are, these are really banged up businesses. So here, if you're looking at my screens, can we pull that up? There we are. So yeah, it's a $7.7 billion market cap, but it's a $42.5 billion enterprise value. So you have to think about the value of this business as a combination of how much equity value it has and how much debt. And there's a lot more debt than there is equity in this thing, which, by the way, also contributes to the volatility of the equity because it is levered almost 5 to 1 here, right? So my problem with these businesses is that they have razor thin margins. Cash flow generation has been spotty at best. We are not getting top-line growth. Speculative long, yeah, okay. I don't have it. I don't touch it. It just, I mean, this one just looks like a lot of trouble to me. It could, could go to zero, frankly. The equity value could, if they don't pull it together. And so, yeah, think about it as a speculative long. I'm not in it, and I don't have much interest. But again, it violates a couple of my biggest rules. Generally speaking, I like to look at stocks to be long, not short. And I look for companies that are growing the top line at least as fast as the economy, and preferably much faster. Bear in mind that the S&P grows earnings at 6-7% a year. So, to me, I'm looking for companies that can achieve that. And if they can't, kind of off my radar, I might toy around with them to trade here or there, but that's about it. I wish I had more for you. Maybe I'll look at it before Wednesday and give it some more thought, but this is not an area of expertise for me. I just don't look at these companies that much. And also, I'm always troubled by businesses that face significant regulatory risk, assume big liabilities, potential civil health liabilities, things like that. I mean, yeah, it's not something that I really get all that crazy about, to be honest. But maybe there are some people who are watching this right now that have more expertise in this area than I, and are willing to weigh in. I mean, it definitely has that place where you could get contrarian in it. I mean, looks like my view is not. So this is one of those places where the boat is very one-sided. I don't like it. Apparently nobody does. Look at this. 4 sells, 12 holds, and a hold is just another way to say sell as far as the street's concerned. And only 3 buys. That is a really, really poor view from the street in this. So yeah, you could get some bear market rallies in it, I suppose. But yeah. Is it true that portfolio managers make their tax loss sales in October? So there's a little bit of optimization that goes on. You are going to, anything that you're not that, there's 2 things happening here. One is that you may have something on the book where you have a tax loss sale, which makes a good offset. And it's really, is one of the things I hated the absolute most running a 40 Act fund was the tax considerations, because I really feel like that shouldn't be that's not really how you should be thinking about capital allocation, is the tax implications. And what's harder is that, we did not know whether people who were invested in that fund held it in a tax-deferred account or not. If it was all in tax-deferred accounts, then the tax implications were moot. So not knowing that as a manager was a real annoyance. I don't want, the last thing I want is for investors to, and I'm not running that fund anymore, by the way. So we shut that fund at the beginning of this year. But the last thing I wanted to do was have somebody get a tax bill. So they're sitting there in January, and all of a sudden they get a thing that says, oh, by the way, you owned, Mike's fund here, and they were up 22% of the year. You thought that was great. You paid your 1% in fees and all the rest of it. And oh, by the way, you owe some taxes. So not that great. But the thing is that if you had a stock that you've changed your view, where you could take a tax loss, you wanted it off the sheets. Do you even want that on your sheets, where somebody who's evaluating the fund, that is evaluating you as a fund manager, is looking at something that you actually don't even want to own anymore? Then that would also be an incentive. So the interplay of taxes is going to be important. Yes, it's going to happen most likely, as the end of the year approaches, because you're going to be manipulating a couple things. There is a window of time during which you can't repurchase the stock. So even if you just want to realize it before you can actually get back into it, so that can also play into it. So there's a couple things that work on. But yes, I would expect once you get into Q4, you can start to see some tax loss harvesting, we might call it. So especially if they're looking to monetize positions that have done well. Doesn't lower volume lead to doesn't lower volume lead to higher volatility and less efficient prices? Major news on days when people on vacation lead to inefficient pricing. This is a question from PC. It is, so that's really, it's what you're talking about is liquidity. The more liquidity there is, the better, all else equal. But that's not always, it's not always the way. There can be circumstances where, in a lot of, you won't see a lot of volume. Options volumes can fall off quite significantly, but the liquidity will remain in a lot of these bigger stocks. So even if you saw NVIDIA's volume get cut in half, that doesn't necessarily mean it's not going to be suitable liquidity. But for equities, it is true that when people are on vacation, guys are off the desk, fewer participants can mean that there is less depth, less market depth, less liquidity, and that can contribute to volatility, yes. All right, where may TLT go before the next FOMC? Is it good to buy now? Have extra money, do not need it for the next 8 to 10 years? I'm assuming, you said 80 to 10, but I'm assuming you mean 8 to 10. I don't like, so let's just get this right out there. I'm going to pull up a longer term chart of TLT. Do not buy TLT thinking it's going to get back to this level back here, because that ain't going to happen, or it shouldn't, because sub 1% 10-year rates, and TLT is longer dated, so TLT is 20 plus year. I would like, I think I've said this on previous live streams, I'm more in that 5 to 7 year corporates, investment grade, you know, trip B kind of an area than I am in taking on a lot of duration. And this is definitely going to be true if inflation genie comes back out of the bottle at any point. It's going to be a really tough spot to be. You buy TLT or sell it for duration to make a bet on long-term rates, more so than you do to realize those rates. If for no other reason that if you are going to own long-dated treasuries, you should go to the Treasury's website and simply buy them direct. But I wouldn't do that either because I don't like taking a lot of duration. I don't know that the inflation genie is licked. And you can get similar rates in shorter paper with a whole lot less duration risk. So, you know, that's probably a better place to be. My 2 cents. MM says it was Dees regular way. What was Dees regular way? Sorry, MM, you were asking. I'm not 100% sure what you were referring to there. Anyway, as producer Jay has just advised me, I've been droning on, as I always do, for a very long time. And I'm not going to make you suffer through any more of it. But for those of you who stuck around for as long as you did, I really do appreciate it. Thank you very much for watching. Like, subscribe, tell your friends, and come back and watch us again when we do this on Wednesday at 4:15 Eastern. Thanks for watching.